Hi everyone, welcome to today's video. So on today's video, I'm going to discuss with you 10 critical lessons that I have learned as a macro investor in my 10 years of journey of investing. Now you'll say that, okay, why should we trust you? Have you ever made any money? Yes. So here is a screenshot. Now you'll say that, okay, Photoshop. It's okay. Here is the video. Please go and watch it. And if you speak with my member community students, if you speak with my stock market students, they will all tell you that they are sitting on very, very good profits. In fact, let me post a screenshot also. So the objective of this video is fairly simple, that I will break apart 10 very critical rules of investing that I have learned, and I will relate it to today's stock market. It will allow you to understand what type of assets you should be buying, not buying, what is it that you should be doing. It will give you an idea. This is a serious investing video. This is not like 1 minute reels and all that stuff. If you are done scrolling with them, then only come and watch it. Otherwise, if you don't have the time to watch this entire video, no problem. Please don't watch it, right? I mean, that is the simple thing that I will say. Otherwise, if you understand half the things, implement half the knowledge, then you'll say, loss ho gaya, this, that, right? So please watch it seriously. This is a very, very serious video. So let's kickstart. And also a very quick shout out to our sponsors for today, which is taxbuddy.com. It is an excellent tax filing platform. Tax filing season in India is well and truly underway. Thousands of taxpayers have come forward to avail their massive 40% discount, which was valid till 31st of May. Now, that discount has been rolled back to 35%, and this is going to be valid till 15th of June. You're probably thinking about that, why should I file taxes early? Well, it is much more beneficial to plan your taxes efficiently, and do file your ITR before 15th of June and enjoy TaxBuddy's seamless tax filing experience. So back to the video, and the first critical point that I have learned in my investing journey is that the nature of risk has completely changed. For example, you would have recently noticed that in the recent budget of 2023, the tax advantages of debt mutual funds have been completely done away with. Now, what does that mean? It simply means that your debt mutual funds are going to be treated exactly like fixed deposit. So you tell me in the comment box, does it make sense to invest crazy amount of money in debt mutual funds? The answer is probably no. So these are small things that you actually need to know as an investor, because you might be investing crazy amount of money thinking that debt mutual funds mein to hamesha paisa banta hai and I'm going to keep on buying them. It will just be nonsensical, right? So that's a simple message that I'm trying to tell you. Now ask yourself a simple question, that why these type of changes, which are not very healthy for a retail investors, are being applied. Okay, pause the video, really think about it. It will make you think about the stock market holistically. Well, the answer there is very simple, and I will show you a graphic first and then I will explain it. So see, here is the deal, right? For example, if you're trying to buy real estate in India right now, the stamp duty has gone up substantially over the last several years. Earlier, you used to pay maybe like 7-8%. Now it has gone up to 10%. So 2%, right? I mean, if you're buying like a 2 crore house or 1.5 crore house, then 2% additional difference becomes a lot. So tax changes have been brought here. What about debt mutual fund? I just gave you an example. What about gold? You will say, yaar, I can go and buy like sovereign gold bond. That is not real gold. Real gold is like, can you buy like physical bars up to a certain point? The answer is no, you cannot buy like a lot of physical gold. It becomes like illegal. So what is happening at a more strategic level? Well, risk shifting is happening. What the government is basically pushing you to do is that transfer your money to more riskier assets. Now, what is the riskier asset? Well, it is the equities. Now, you'll say, ki yaar, FD mein bhi to return banta hai, right? You can shift your money instead of debt mutual fund to FD. And let's speak about it by juxtaposing two generations. So let's speak about you and your parents. Now, in our parents' time, what used to happen? That our parents, if they did fixed deposit or if they purchased any land, and even if they simply invested in the stock market, there was real growth happening. Now, what is the meaning of real growth? Real growth means this. For example, these days, you might be hearing the news that inflation in India is 4.6%. That is the CPI inflation. Now, have you thought about how this 4.6% number comes? What are the underlying constituents of it? How is this designed? What is the basket of good? Have you thought about all these things? Now the answer would be no. Akshat, you tell us. Okay, so that becomes an entirely different conversation. So I will link one of my LinkedIn posts here. Please go and read it. It is politics neutral. the summary that I will give you there is that, see, this is the stated inflation in the economy, but the real inflation in the economy might be like 10%. There is no official data on it, but you yourself think about it, read this post closely, and you will be able to ascertain it. So what is the concept that I'm trying to teach you? Well, the concept is that, see, back in your parents' days, your parents could easily invest in FD and get real returns. But can you do the same? The short answer is no, because if you are depositing your money in a fixed deposit right now, you might be making like 7.5%. But what is your after-tax return if you are in that 30% tax slab? Now, the after-tax return might be like 5%. But what is the inflation in the economy? Well, the stated inflation itself is close to 5%. So in real terms, the only few instruments where you can go and invest your money are equities. So like it or not, we have to take risk with our money. Do I like taking risk with my money? The answer is absolutely not. I do not love taking risk with my money, but we are left with no other option. Even people who are banking their retirement on debt mutual funds, कि यार bond में पैसा डाल के छोड़ देंगे, this that problem, right? I mean, you have to take risk with your money in order to beat inflation. So that is the concept of risk, that the way the tax structure, other alternate assets are being designed, we are left with very little option but to go and pour our money in equities or other forms of assets. I am not pushing you that go and do like equity investing, this, that, but please understand this fact and acknowledge this fact. That is the simple message that I am trying to give. Now, the second key point that I've learned about the market is that it is very, very difficult to identify what is the real value of a stock or an asset. Now you'll say, yeah, you're talking about stock markets and you don't know how to value a company. Now that's not only me. Take a look at like Wall Street analyst. Take a look at so many companies who give like commentary, ITC ka stock is like this value, that value. Are they able to get things right? The answer is no. Even if you are the most seasoned investor, 50% of your bets will go wrong. Why are they going wrong? Simply because of the fact that figuring out the true value of anything is becoming harder by the day. So let me walk you through an example and tell you and prove it with some data. So see, one of the principles of value investing is to look at price to equity. And this is the PE ratio of Nestle. It says that it is 81.8. Now what does this mean? It simply means that in order to make 1 rupee from Nestle, you first have to invest 81.8 rupees. Now people who believe in the concept of value investing, they'll say, this is like overvalued. Who buys like a stock which is like 81 PE? You should never buy anything which is above 30 PE. Okay, so let us work through the chart of Nestle. And here I am showing you the entire PE ratio of Nestle. And you'll see that it used to trade at like 30 ka PE in 2008. So you could have potentially considered it. But once it moved to this point, right, almost 50 ka PE was at November 2010. So you'll see that, okay, 50 ka PE, what's the point of buying this? This is like ludicrous, right? Why would you buy it, right? And then what happened? The PE kept on expanding and it never really came back to that 30 PE. What happened to the prices, right? So if you would have purchased the stock back in 2010, 2011, it was trading at 3,000, right? Now it is trading at 21,000. So it has gone up 7 times, 7x. That is like absolute crazy returns. But you would have missed all these gains if you truly tried to find the value of Nestle. And if you would have simply looked at PE ratio, PE ratio very high, you would have never purchased it only. So that is a simple point, that these days it is close to impossible to figure out the exact value of a stock. You can do mota math. That's the only thing that you can do. For example, right now, I keep on saying the stuff. I'm buying like IT index. I'm buying a lot of consumer durable companies. I am not buying finance stocks now, right? 6 months, 10 months ago, I was aggregating finance stocks like crazy. They have given me crazy amount of run up. I was aggregating Nifty 50 like crazy. It has given me massive run up. So let me very quickly show this data on the chart also. See, if you take a look at Nifty IT, then from its top, it is still trading at like a 26% discount, right? What about Nifty 50? This is the collection of top 50 stocks in India. So if you see this, right, this is where we are trading and this is the previous high. So it is almost at its previous high. Now, am I trying to debate कि भाई Nifty की true value क्या है? I cannot do that, right? I mean, I cannot do the valuation. No one can tell you that whether this is overvalued or undervalued. But if you do a relative comparison, it is fairly easy to think okay, Nifty ID is discounted. Now, if it appeals to you, you could potentially consider making some investments. Now, there is so much excitement going on. Bank Nifty, telka macha dega, this, that. Okay, so let's look at Bank Nifty. And by the way, almost 40-50% of my Indian stock portfolio comprises of financials. I've been saying it. Again, please watch some of my old videos. I've already built those positions like way back, approximately like 9-10 months back, right? So that's when Nifty Bank was trading at a discount. I had individually aggregated so much of like Kotak Bank, ICICI Bank, Axis Bank, HDFC Bank. But anyways, let me show you this chart. So here you will see that Nifty Bank is trading at its all-time high. Now people are debating, bhar ke khareed le. Answer is no, you should wait and watch, right? This is what aggregation means. So the point I'm trying to drive home is that, see, in a market, even in a bull market, bear market, sideways market, if you are trying to do valuations, it will be really, really tough. But you can always find relatively undervalued things which you could consider building your positions on. Right now, one of the assets in which I'm building a lot of position is small cap. Let me show that to you as well. So it is trading roughly at 21% from its peak. So if you could pick individual small cap stocks, even if you're picking indices intelligently, timing it well, there is a very good chance that you are actually getting all this stuff at a discount and you're going to make very high returns from it. So which stocks, which assets am I buying? I give fundamental commentary on my YouTube member community section. So if you consider it to be worthy and if you are a serious investor, do consider joining it. So with that said, let's move to lesson number 3. See, stock market is a conviction game. Now I will give you an example here of the Meta stock. Now please go and check, literally type out Akshat Meta stock. And what you will find is that I actually purchased a lot of Meta stock somewhere around this $200 range. Why? Because it had fallen from almost like 360, 370 and it had exhibited almost like a 50% fall. That is when I started building very high positions in it. But unfortunately, you would see that, okay, I maxed out my positions here and then the stock continued to fall, right? And it fell to like almost $90. I started receiving like a lot of hate, right? So you've gone crazy. Why did you talk about this stock, that stock? So after that, I simply suggested that, see, you know what, this is a good company. Fundamentals are good. It will come back up with the market. And look what is happening to it now. Now, this is not an individual stock that I'm speaking about. Take a look at Bitcoin over the last 6 months. Take a look at something like Ujjivan Small Finance over the last 6 months. The point is that you will only make money in things on which you have conviction. Now, why is this conviction such an important point? Okay, so let's work through the Meta example itself. So let's say that you watched my video here and you purchased like $1,000 worth of Meta stocks. Then it fell. Now, what is going to be a normal reaction? Ki yaar, Akshat ki wajah se nuksan ho gaya, right? I mean, this YouTubers, these influencers, they are just fooling people. They are running scams, this, that. Okay, so does cribbing about me or any influencer help you? It doesn't help you grow. Why did you purchase stuff here if you did not understand it? I will tell you why. Because you are working on something called as borrowed conviction. That, okay, this falana dhimka person told me something, therefore I bought it. Now, if I make money, then I'm very smart and I took the risk, therefore it is my money. But okay, if I lose the money, then this person is responsible and he or she should return my money back. Now, that is not the way investing is done. You cannot work on borrowed conviction. For example, right now, I'm very bullish on consumer durables. I am bullish on small caps. I am bullish on Nifty index. Now, if you're just going and buying all this tomorrow, and if you have no conviction, no understanding of these stocks, thoda sa bhi fall aayega, you will start panicking. So unless you yourself have conviction to hold it through the panic and see the rewards later, please do not buy it. Please learn about the fundamentals of the stock market. Please invest some time, effort, energy. कोई ट्रेन नहीं छूटी जा रही है, कोई बस नहीं छूटी जा रही है, right? I mean, you can literally spend a year learning about stock market, then start putting little bit of money, then put more when you have conviction. But the point is that you need to have conviction. And if you don't have conviction, then you're just simply working on stock tips and you will never be able to become a good investor. The fourth point that I've learned about the stock market is that a 50% hit rate on your stock analysis is a very good hit rate. I'll say that, okay, this is complete nonsense. Biggest investors have like amazing hit rate, like 100%. No one has like 100% hit rate. If you are hitting, for example, if you're picking 10 stocks and 5 of them survive and do what you have thought they would do, you are going to make very good money. Now, can I give you an example? Yes. So for example, I was very, very bullish about small finance banks approximately 8-10 months back. So I purchased AU Small Finance Bank also. I purchased Aavas Financiers also. I purchased Equitas also. I purchased Bandhan Bank also. I purchased Ujjivan Small Finance also. So I spread my portfolio accordingly. Now, unfortunately what happened was that Ujjivan Small Finance fell and even Aavas financiers fell quite a bit. So 2 out of 4 of my stocks, they corrected quite a lot. But Equitas Small Finance actually became like a multi-bagger stock for me. So here is the return that I have already made on Equitas Small Finance. I sold approximately 30% of my portfolio. I had built very high positions on that stock. I was able to intelligently upward average it. Now, why am I telling you this story? Well, the reason there is very simple. Let's see, I was working on certain thesis. For example, I was of the belief that, hey, small finance banks are going to do well. Now, did I go crazy? Ki sara paisa ek hi stock mein I'll put? No. All right. I spread my risk across multiple banks that I saw value in. One stock gave me like immediate returns. Ujjivan Small Finance now has started to give me a lot of returns now. Some stocks like Aavas are beaten down in my portfolio. Am I panicking about this entire small finance bank situation thing? The answer is no, absolutely not. I'm still holding Aavas from that perspective. Now, people start panicking कि यार आपने तो आवाज बोला था, हमने तो आवाज खरीद लिया. Bhai, did you buy other stocks also and hedged your portfolio correctly? Did you understand how to build your positions? Please do all these things. Only then, this 5 out of 10 thing that I'm speaking about, it would make sense for you. Every intelligent investor hedges their portfolio and works accordingly. I try to outline as much transparency as possible, but people are making very, very difficult to give these honest advice openly. So anyways, I try to tell you everything very honestly and openly. But you need to do your further due diligence on it, and please work with the understanding that 50% of your calls will also go wrong and 50% of whatever I'm doing in the market will also go wrong. You need to be prepared for that situation. So let's move on to the next point, which is that in the stock market, you need to control your greed. Now, what is the meaning of controlling your greed? To explain that, let me take you to ITC. So here is the entire chart of ITC, and you will see that almost for like a decade, right? Almost like 2022, it hardly moved, right? People started calling ITC a dud stock. So much negativity started happening around ITC. Memes were being made, whatnot, right? Then ITC started running, and it started running like crazy. Now again, please go back and watch my videos. Just literally type out Akshat Shrivastava ITC. I was one of the very few people supporting ITC stock. I was an investor. I was investing crazy amount of money. I had built a lot of position on ITC around 200 levels, and I sold it off at roughly 300 levels. I have completely exited ITC. Now there are 2 ways to look at this story. Number 1 way is that you know what? You know nothing, because if you had known, then you would have pocketed even more gains. You would have made like 450 rupees on ITC stock. Okay, that is correct. But see, how much money did I make, right? So I made almost 50% returns and dividends on something like ITC, which is a stable, safe stock. Now you tell me whether 50% return is good or bad. Well, 50% return is very, very good. No doubt about that. But another way of looking at the story is that, you know what? You missed out like so much potential gains, right? You could have made like 150% profit or whatever. See, you cannot be a maximalist in the stock market. Again, as I related it to the earlier point, that valuing anything is extremely complicated now. You can't identify the absolute bottom of a stock and the absolute top of a stock. You have to eyeball it. Sometimes you will be right, sometimes you will be wrong. Right now, I'm eyeballing small cap. My estimate is that I'm going to top it off, sell it off at like 60-70% gains, whatever index I'm buying. And individual stocks, I'm targeting like 100-150% in some of the stocks that I'm purchasing. And accordingly, I will taper them off. Now, can they go high? Yes, of course. Can they fall also? Of course. But I'm hedging my portfolio. I'm building my portfolio accordingly. So I hope you got the point that there is no point in being maximalist and thinking कि यार absolute profit कमा लेंगे या absolute bottom पे खरीद लेंगे. You can't do that to begin with. The 6th thing that I learned about the stock market is that you will never make money in a straight line fashion in the stock market. When I started investing, my viewpoint was that, hey, if I enter the stock market here, the stock market will go like this, right? And every year I might be making like 12% return. Why 12%? Because everyone used to tell me, you know what? Nifty 50 में invest कर दो, every year you are going to make, or your average CAGR will come out to be 12.3% CAGR. So I started expecting, or I started telling my brain कि यार निफ्टी में इन्वेस्ट कर दो या स्टॉक मार्केट में इन्वेस्ट कर दो, यू आर एनीवेज गोइंग टू मेक 12% रिटर्न every single year. So okay, so that was a very bad thought process. It doesn't work that way. See, the way it works is that there are so many fluctuations in the stock market that it is better to look at a 5-year journey on the stock market, right? You need to ask yourself a very simple question. Hey, can I double my money in 5 years? If the answer is yes, then yes, you are doing fabulously well in the stock market. So instead of doing this, that every year I'll make 12% gain, I started orienting my brain that every 5 years I need to double my portfolio. That is the vision with which, and that is the risk profile with which I am going to operate in the stock market. Why does that work, mathematically speaking? So let me give you explanation around that as well. So take a look at this graphic. You can go and read it. Basically, what you will realize is that markets stays sideways 70% of the time. So 70% होता ही है कि you just move like this, right? What has been happening for the last 2 years. This is not an anomaly that the markets did not give returns for the last 2 years. This is typically what happens in the market, that 70% of the time, net you're not going to do anything in the stock market, right? So during these type of markets, you need to design your portfolio separately. During bull run, you have to design your portfolio separately. Maybe take some more swing trades. During a bear market, depending on technicals, might make more sense. So the point is that strategy for every different type of market is different. So accordingly, I started resetting my expectation, and the goal with which I operate now is very simple, that 2x your portfolio every 5 years. So now you might have a natural question that, hey, how are you going to double your portfolio in this bull run that you have been speaking about? It's very simple, and I will show it to you right after 2 to 3 years. I'm hopeful that my portfolio will double from this point. How? It's very simple, right? I mean, just buy things that are undervalued as of now. According to me, these would be something like small cap as of now. It would be something like consumer durables, Nifty, IT, all these things are undervalued. Bunch of individual stocks are also undervalued. I've done a separate video. Please go and watch it. And I keep on adding more things to my list. And again, I make all the quick announcements on the member community. But the roadmap is very simple, that hey, buy A, undervalued things whenever you find the opportunity, depending on the market. B, ride the bull run, right? Every 4, 5, 6 years, there will be a mini bull run that will happen. If you are able to capture that, again, take a look at this graphic, that if you miss just 10 good days in the market over the last 40 years, your profits would have shrunk dramatically. That happens in the Indian market also, that happens in the US market also, that happens anywhere in the world. So please remember that the idea right now is not to miss those 10 good days. It is very, very likely that we are going to witness at least 2 to 3 such good days over the next 6 months to 1 year. So believe in this 2x philosophy rather than trying to make 10% gains every year. Now comes point number 7, and I don't know where this myth started, which is the difference between active income and passive income. Now many keyboard warriors, they start the war that, you know what, अगर आप stock market से पैसा कमा पाते तो आप YouTube पे क्यों होते, and वगैरह वगैरह nonsense is there, right? So okay, so let me help you understand this topic fundamentally. There is something called as active income and there is something called as passive income. What is the meaning of active income? For example, you go to your office, you work, spend 8-10 hours, 1-2 घंटे आपको ready होने में लगते हैं, you go take taxi वगैरह वगैरह. So a work day eats up like 12 to 14 hours easily for anyone's life. Now that is active income, that you're going to office every day making money. Now in the stock market, are you sitting in front of your screen 14 hours and making money? The answer is no. Do I sit in front of my screen every day 12 hours? The answer is no. So the point is that when you are spending your active time on something, you are supposed to make more money from it. That's a simple message, right? So you're not supposed to make like equal amount of money from the stock market and from your active income stream. Whether you are doing a job, whether you are doing a business, whether you're doing content creation, whether you are writing a book, all these are active form of investing your time. You are supposed to make more money from it. Stock market, according to me, is a vehicle that preserves your wealth. It is a passive source of income. It can give you good money, but provided that you are doing well with your active sources of income. That is a simple message. Intelligent people got my point. Others will again be arguing with me on the keyboard warrior thing. So I can't argue with you. So with that said, let's move on to the next point. Now the next point that I figured out in my stock market journey is that commissions are really, really bad. Now, if you don't know any form of investing, कुछ पता ही नहीं है, बस invest करना है, go through active mutual fund route, there is nothing wrong with it. But please realize that there is a huge difference when you are making 12% returns from stock market or your investments versus 16%. That's part A. I'll explain you the math. And part B. Many a times we think, yeah, 2% commission किसको दे दिया और 2% commission we give, क्या ही फर्क पड़ेगा? So okay, so let me explain you the math. See, if you are doing an investment of 25,000 rupees per month for a period of 30 years, if you are young, you will have that lifespan of investing, and your wealth grows at 12%, then you are making roughly 8 to 9 crores as your corpus at the end. Now, just change one thing on this equation. Instead of 12%, move to 16% returns. How much do you think the portfolio difference will be? You'll say, yeah, maybe 2 crores, 3 crores. No, it becomes roughly 22 crores, right? So it's almost 2.5 times your portfolio. So that is the power of difference in terms of 4% difference on your returns. That is where the magic lies, because it puts you from that wealthy category to ultra wealthy category. And the only way you will be able to do it is that if you learn how to manage risk, how to manage your own portfolio. Now, I am very few finance influencers right now on YouTube who manages his own portfolio. I do not manage other people's money. I just simply talk about whatever I am doing in the market. That way I gain experience. And I also save on that 1 to 2% commission that people end up paying to PMSAs and all that. Now you might have a counter question that, okay, 2% से क्या ही फर्क पड़ जाता है? Okay, see, there are a lot of points that you need to consider here. Number one, when you give money to a mutual fund manager, irrespective of the market, they are going to put that money in the market. It becomes like a obligation for them to do it. So even when money should not be invested in mutual fund or PMS, it is invested. So that's problem number one. Problem number two, when you manage your own money, you understand the fundamentals. You can rotate it more sharply. That is what allows you to make that additional 4% return. Now, many of you would be thinking, "Aapne kabhi kamaya 12% return?" Again, please go and watch my video. In a dying market, I was able to make 12-13% return. So I will just leave that conversation there. Retail investors can make 12-16% return easily by following simple investment strategies, picking good investment instruments, and taking sensible risk. Some of those risks can go off, no doubt about that. But if you are sensible, then net you will be a winner in the stock market. And please, my urge would be that at least learn about this. It's not as if that you need to shift your mutual fund immediately to something else, but at least learn about it, because over a lifespan of 30-40 years of investing, if every year you are losing 2-3% commissions, then it becomes like a bad scenario for you. So now this video is getting a little bit longer, so I will save the rest 2 points for my next video and community post. It was about macro investing and why taking contrarian bets make a lot more sense. So I will write 2 specific posts on the community video. But I hope that these investing strategies is something that you can apply in today's stock market and make good returns. If you don't know how to design a portfolio, here is a video that I have done. I would highly encourage you to please go and watch it. It would allow you to redesign your portfolio in this existing bull run. Thank you so much for watching, and I'll see you soon.